Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is December 13th, 2024. S&P sitting at 6,045. I'm joined by Kevin Ferrari today. Talk a little markets, talk a little trends, maybe change of trends, maybe sideways trends. Is there anywhere you would like to start, Kevin?
I think you're kind of talking about maybe potentially moving sideways here a little bit. I think that's been, at least personally, kind of from what I've seen this week, the most consistent theme. Because I know with the way we kind of split some of the areas in the market, I guess I've had a little bit more of a value tilt, I guess, lately with like industrials, staples, things like that. Even the S&P sideways week really haven't gone anywhere. And I know like when I've been looking through a lot of these individual stocks, charts of those, and like some of these sectors, you're seeing a lot of those that really have had pretty strong last couple of months, really starting to consolidations set up. So I don't know. I guess it would be natural, right, for a lot of those names to kind of digest some of those gains here, which makes sense. But yeah, especially on the value side, though, value's been getting
terrible,
pretty hard. Right?
Yeah, if you look at like SPYG versus SPYV, it's just another big move recently in favor of growth, in favor of large and mega cap. NASDAQ versus Russell 2000 relationship has made another big jump. And that's really been a pretty even battle going back to November of last year. Big moves from both sides at certain points, but overall pretty in line with each other. Kind of maybe like NASDAQ ready to take another move higher.
Mm-hmm.
I really thought after the election that we would see, and we did see pretty strong breadth thrust. We did see a lot of participation for a couple weeks, but certainly here, first 2 weeks, December, man, a lot of that outperformance has been sucked out right back to the mega caps. And you, before we jumped on, you were kind of going over, right? Most assets, a lot of assets, day after the election, it's on November 6th, Wednesday, November 6th. A lot of big gaps.
Mm-hmm.
And would you take us through kind of what has happened since then with certain areas of the market?
Yeah, for sure. I think this is where kind of the gap started becoming a little bit more evident, was just looking at kind of that difference between growth and value. Because when you start looking at some of these sectors, well, XLE for energy, essentially they've filled that November 6th gap already and actually continued lower here now.
A negative reaction since the election then really for energy.
Mm-hmm. Yeah, basically initially positive, and then towards the end of the month there has been getting sold off pretty steadily. Materials, which have been pretty bad there for a while.
Materials.
Essentially filled that gap immediately and kind of bumbled around there for a little bit, but have been getting sold off pretty steadily. Some of these areas, we're talking like 9-10 days of down days, like down 9 out of 10, down 9 straight, 10 straight for some of these areas.
Hey, we're getting Russell 2000 today on track. 7th day with a closing price below the open, and 12 out of the last 13 with the same characteristic.
Mm-hmm. Yeah, and that's starting to become a little bit more evident in some other areas too, which, and that really where it gets, I think, kind of interesting too with those November 6th gaps. Like when you look at industrials using XLI, haven't filled that gap yet. Kind of look like that's potentially what they might be doing. Really, XLI is only probably like, 1.5% there roughly.
I look at this chart.
Right.
Really, we got to slam on the brakes here, XLI.
Mm-hmm. And I think what you were kind of talking about this too before we hopped on with like financials and regional banks. I think that's the one that has the most potential to be hit the hardest if we're going to fill this gap, right? Just financials in general is almost 6% from that gap yet.
Yeah.
Whether or not it's actually going to try to come fill that, who knows? But with a lot of these other areas filling the gap, just kind of makes you wonder, right? We're going to see that too from financials, regional banks, industrials almost there. But at the same time, talking XLC really hasn't looked back for the most part. Um,
XLC by far one of the strongest.
mm-hmm.
But yeah, that's more of your runaway gap. I would put XLY in that category too.
Yep.
And we've seen that. I think Dave has discretionary workbook, but you see it. I mean, retail pretty darn strong. A lot of these online retail ETF really they've got really nice looking relative charts. eBiz or an ONLN. Consumer discretionary, definitely strong. Of course, Amazon, Tesla, that helps. The mega cap theme, right? We've had Apple broke out a couple weeks ago to all-time highs, finally got above the 236, and it's been cruising. We've got Amazon came back and retested its big breakout area around 194. Yeah, they've been strong.
Meta's
Google
still
hit
strong.
all-time highs earlier this week.
Yeah, like all those kind of FANG, Magnificent Seven names, things like that were pretty hot kind of leading into the election seem to be kind of picking back up here.
And just on the week, you've got XLY, XLC staples, but everything else pretty solidly in the red. Materials, utilities, healthcare, the worst. So that doesn't make me too nervous.
No.
Russell by far the worst this week. You've got NASDAQ positive on the week, down 2.5%.
Right. And I guess from like market cycle and sector rotation perspective, the areas that we're seeing kind of hold up and still perform well, like technology, discretionary, communication services, are still the areas that you would expect to be performing kind of the best, relatively speaking, while you're in the midst of a bull market. So
yeah, you make a good point. Even with a few months of underperformance, if you zoom out, and this is some big tech super cycle, then yeah, I like that. You've really got to assume that when all the dust settles, mega caps and tech, and that's going to be your leader coming out.
right.
And that's what you'd get, right? I think it would be really cool to have a 90s bull market. Right. That's what you would see. You're going to have another big, obviously, it's not going to be .com, whatever they end up calling this.
AI. It's going to be
AI
the AI.
or metaverse, bubble or whatever, crypto. Crypto's held up pretty well this week, given the weakness in stocks. Still 100,000 on Bitcoin.
Mm-hmm.
Had a rough Monday, but we're above where we were a week ago.
Right. Yeah, it'd be nice to see Ethereum get above like 40, 60.
Yes.
It's been here for a while, but still holding up for sure. Yeah. Yeah, and even like a lot of your blockchain and other like crypto ETF related funds, things like Bitcoin miners have been holding up well for the most part. So I think that area as a whole has kind of been doing all right.
Agreed.
But we'll see, right?
All right, so stocks, some taking a break. The mega cap sectors cruising, so that obviously helps. Major indices that we know are tilted that way. Breadth kind of falling off. You taking equal weight S&P versus S&P. That's certainly rolling over. So outside of that, where are we looking? How are we looking in the fixed income space? Can we run to long-term treasuries yet if we're scared of stocks?
I don't think so.
No?
No. Yeah, TLT, 20-year treasuries getting hit pretty hard, just aggregate bonds in general.
Terrible. Terrible week from long-term bonds.
Mm-hmm.
Maybe we'll see. Could be a big base. This could take another year or two if they're going to turn it around. I guess is not. But yeah, rates right back higher, which is what you would expect in a rising rate environment.
Yeah, it makes sense, right?
Gonna air to, they might get messy for a few weeks or few months. Actually, rates are where we were at late November last year. So if I look at a 30-year treasury yield, last November 30th, we were sitting at 4.5. Today we're sitting at 4.6. Now, when you zoom out, right, you get more context to that.
Right.
But to the point we've been trying to make the last 30 seconds, you got to assume that it resolves higher, and that means higher interest rates.
Yeah, so we're still definitely seeing the lower duration funds still hold up the best, and especially I think we kind of talked about quite a bit before too. Especially seems to still be tilted towards kind of your lower credit qualities too as well. So that even within the fixed income space, maybe long-term bonds aren't necessarily at play, but it's not like it's risk off totally within that area, which is good to see.
If you pull up like a J&K versus AGG, that's not bad.
No.
I mean, that's a strong uptrend. Same with credit yields. I think David mentioned earlier in the week, credit spreads had a little bit of a bounce, but you're still not seeing anything from fixed income. I don't know, maybe everyone's positioning for 2025. What do they call that? Window dressing.
Oh, yeah. Got to get your tax loss harvesting in.
Pretty. Got to let everyone know that you own the Bitcoins, all the best stuff from the year.
Right. Yeah, and if you got some of those losers for tax purposes, right, you better harvest those losses.
Harvest them like a good farmer. So not as exciting as an environment the last week or so, unfortunately.
Well, we probably could have just took this week off.
We could. Hey, there's no one that wants stocks to go up every single week more than me. But it's healthy. It's healthier if we don't do that. We take a break. When this isn't even this is not, and I don't want listeners or clients to think that we are in the midst of some correction. This is not rolling over. Stocks are where we were at 10 days ago. We've just been sideways.
Mm-hmm.
Not trying to sound the alarm bells. Now I will say, yeah, we're getting up there. Visually, when you look at an S&P, when you look at some of the breadth numbers, like I think Mark Newton had a good, you look at something like stocks above a 200, that has fallen off. There's some other things out there. We are definitely extended. Would a good 5-10% correction probably be beneficial? Yeah. Would it stink? For sure. But we just had, how big was our correction we had this summer? It was a solid 10% back in July and August.
Yeah, and using the S&P, 5% correction takes you back to the November 5th, 6th gap. So you feel that gap, that's 5% right there. Because looking at some of these other sectors, that's kind of what it's foreshadowing. Maybe some of these areas consolidate a little bit, others fill their gaps if they haven't already.
I think you're making a good point.
Chop around here a little bit, and then trend is still up, continue moving higher.
Kind of disappointed. Now, let's keep with that potential hypothesis. I think it's pretty plausible. Now, is that going to coincide with Santa Claus rally? And then we get a negative Santa Claus rally, or we get a negative, January, it'll be by January 30th.
Right.
But the first 5 days of January for set.
Yep, there's the first 5 days. Santa Claus rally is...
And then January barometer, which is the whole month.
Right.
So if we're gonna fill this, I don't know if we're getting there before Santa Claus rally. So, but just something to keep in mind. I certainly like paying attention to those. We do as a team. I think we were 3 for 3 last year. I believe so.
I know we missed one of those for sure.
January might have been. Was January negative?
No, I think it was Santa Claus rally.
Yeah,
So I had that when we did our lunch.
Rally looks because it was good like the first 2 days. We ended up, maybe that was the year before. Maybe that was 2022. Either way, I'll probably have to go back and look at a client letter, a lunch and learn presentation to reboot my memory. But yeah, we'll be paying attention to those. But again, to the point, maybe some colliding forces there with a gap fill and trying to get an early read on 2025. We will see if it matters.
So actually, I went back and found it. So we actually were only 1 for 3. So the Santa
1
Claus,
for 3.
yeah, the Santa Claus rally, we didn't hit it. First 5 days also negative, but we hit the January barometer. And I found, so Stock Traders Almanac actually looked up years where we had a negative Santa Claus rally in first 5 days, but we were up for the month of January. There were 3 years, obviously prior to 2024. So it was 85, 91, and 93. All 3 years were positive. And this is kind of crazy. In 85 and 91 for the full year, they were both up 26.3%. So the exact same return.
I was going to say, aren't we up about 26% this year?
Yeah, probably about that, right?
On the S&P.
And then in 93, it was up 7.1. So obviously small sample size there, but now with 2024, barring some kind of drastic...
S&P up 26.6 as of today, right now.
Isn't that almost creepy how that comes out? So yeah, that scenario now is 4 for positive on the whole year.
Give up 26% in the last 2 weeks, which if that happened, we got way bigger issues.
No, exactly. So we'll see. And that there in and of itself kind of tells you, right, based kind of going back to what you were saying originally, even if we're not necessarily there and we do see kind of a shorter term, intermediate term pullback, as long as it kind of resolves itself by January, right, it's kind of the same setup that we had coming into this year. So time will tell. It's definitely not doom and gloom if that happens, I guess is my point.
No? That's pretty eye-opening. I would not have expected those to be positive. Would have expected like more of a mixed bag. All right, Kevin. Anything else that you would like to share with our clients and listeners before we head out to the cold weekend?
I think kind of the only other thing we've kind of been watching, I think Dave was kind of talking about the dollar yesterday a little bit, messing around with this kind of 106, 107 level using DXY. Kind of between there and 100 has been a pretty consistent range there for a while, the last couple of years.
Yeah, been sitting in here for a long time. Yeah, you're right, about a little over 2 years, November 22.
Yeah, so it'll be interesting to see, is the dollar going to kind of break higher from here? Are we going to see that kind of range continue and going to pull back a little bit more towards 105, 100, somewhere in there?
Probably one of the reasons Russell's struggling. Probably one of the theories floating out there, at least.
Yeah, and really commodities for the most part been kind of sideways as well, which
everyone's waiting. Mm-hmm. Yeah, sideways.
So time will tell on that one. But other than that, I think that was really all I had.
Yeah, kind of in wait-and-see mode. Very short term. Again, strong uptrend. There will be corrections. Had a client letter that went out this week, so if you are a client, please make sure to read and digest that as well. But that is it for today. We wish you all a wonderful weekend.
For sure. And I don't know if I will necessarily be on before Christmas, so I guess Merry Christmas to everybody, and I guess if I'm not on around the New Year, Happy New Year as well.
Thank you, Kevin. Have a great weekend, everyone.
All right. Take care, everybody.